Hi everyone, welcome back to Tax Tutoring and Training. And today's lesson, we're going to be going over how to report capital gains or loss on a tax return. As always, the guided notes will be linked in the description down below. And feel free to fill in the blanks, stay engaged, stay active, and fill out the activities at the end for extra practice. All right, with that, let's get started. So, capital gains are reported on Form 1040, Schedule D, Capital Gains and Losses. And reporting capital gains and losses on the sale of assets is mostly in scope for VITA volunteers. So, if you're looking to get your tax return prepared, VITA volunteers can prepare returns for people who have capital gains or losses if the capital gains or losses are from mutual funds, stocks, or the sale of a personal residence. And we'll get to the qualifications on that later. But if you have a net capital loss in excess of $3,000, just know that the excess over $3,000 would be carried into the next tax year and carried forward until exhausted. So on the tax return, you wouldn't want to report a very large net loss. If it's over 3,000, you're going to distribute that loss amongst later tax years. So what do you need to even report a capital gain or loss on a tax return? Well, you need three things. You need the basis or adjusted basis, which is usually found in Form 1099B if it's the sale of stocks or mutual funds, or Form 1099S if it's the sale of real estate. The basis is the original cost of the asset. So it would be how much you paid for a share of stock or how much you paid for the house if it's real estate. The adjusted basis is the original cost plus any increases to the cost. And that could be commissions, fees, depreciation, that sort of thing. The holding period is basically how long you've had the asset. And that determines what tax rate you're going to be taxed at because long-term capital gains have a lower tax rate than short-term ones. And the holding period is basically when the asset was acquired and when it was disposed. So you're going to look at the forms that the taxpayer brings in to determine the holding period. Proceeds from the sale. So again, Form 1099B will denote any proceeds from the sale of a stock or mutual fund, and Form 1099S will denote any proceeds from the sale of real estate. And the net sale is what you're going to be using to calculate capital gains or loss. So the first type of capital gains that we're going to be talking about today is the capital gains of a stock and mutual fund. And in order to find this out, you're going to first need the basis. And the basis is the cost of stock per share. So that is what you paid for a stock. Say I'm a taxpayer, I paid for one share of Apple stock for $300. That's your basis. It's how much money you're putting into the asset. The adjusted basis is any additional commissions or fees paid to the broker for purchase. So that could be if my broker charged a $10 fee, then the new basis would be that $300 that we put into one share plus the $10 that we paid in commissions. So the adjusted basis would be $310. The original basis per share can be changed, though, by dividends and splits. So what are those? These are activities or processes that a company will do that affects the basis of stockholders. And there are two types. So stock dividends are where a company will, instead of paying money for dividends, instead of paying actual cash to their stockholders, they'll pay a stock dividend. And what that basically says is they just give you an extra stock as a bonus. Like, hey, you're a great stockholder and we did great in our company. We made a profit. So here's this little extra stock that we're giving to you as a gift. And in this case, the adjusted basis of the original stock is split among the total of new shares. So this means that, hey, I have one share of Apple that costs $300. And then my company, so Apple was like, hey, you're a really great stockholder. We're going to give you a stock dividend of one share. So now we have two shares of Apple stock. And the basis per share is now $150 because it's split. That $300 original basis is split between the new total share, the new number of total shares. In a stock split, this is where you're taking an existing share and splitting it into two shares, or however many the stock split denounces. It could be a 3-for-1 split or a 2-for-1 split. 2-for-1 split is usually the most common. So that's you're taking the original share, and companies do this so that there's more of their shares in the market to sell. So in this case, that one share of Apple stock would be split into 2 shares of Apple stock, and it would go from 1 share to 2 shares, and those shares would each have their own basis of $150. So the 2-for-1 stock split would decrease the basis per share by half. To find the holding period of stocks and mutual funds to calculate capital gains, you're going to need the purchase and the sell dates of the stock. Short-term gains are short-term holding period is 1 year or less, so you've had the stock for 1 year or less, and that's taxed at a regular income tax rate. But if your stock or mutual fund is held at a long-term rate, which is it was held for more than 1 year, it's taxed at a lower rate. If the investment property is inherited, meaning you inherited capital gains from stocks or meaning you inherited mutual funds or stocks, then the capital gain or loss is treated as long term. So, say you bought that $300 share of Apple January 1st, and you sold it January 2nd of the next year. So you've had that stock for more than 1 year, therefore it's taxed at a long-term rate when you finally sell it, and the capital gains will be taxed at a long-term rate. In a non-taxable stock split or dividend, the stock or dividend will have the stock or mutual fund will have the same holding period as the original. So, and what makes a stock split or dividend non-taxable? That's when you earn less than $1,500 in profit for selling that stock or mutual fund. In a taxable stock dividend, meaning you earned over $1,500 in profit, the new holding period begins on the date of the distribution. So if you had a taxable stock dividend and you got a taxable stock dividend on March, and then you sold, so you had this first share of Apple, you bought it January 1st, and then you had a stock dividend in March. And then you sold that share of stock on January 2nd again. If you made over $1,500 in profit, then the holding period would begin in March. But if you made, let's say, $900 in profit, which is less than $1,500, the holding date for the shares would be January, because it's a non-taxable stock split or dividend. Okay, and a few other things that you need to know to calculate capital gains for stocks and mutual funds. The first is specific identification. And this is where a taxpayer will direct a broker to which block of stock they want to sell. And this is made before or at the time of sale. So, for example, say I buy 1 share of Apple stock for $300. And as we all know, the stock market's really volatile and it changes every day. So at a later period, the taxpayer pays $400 for another share. So now you have 2 shares of Apple. One's worth $300 in basis, one's worth $400 in basis. And then at a later date after that, you tell your broker, hey, I want to sell one of my shares. Well, which one are you selling? Because if you sell the $300 share, then your capital gains is $300. It's more. But if you sell the $400 share, then your capital gains is only $200 and it's worth less. So you have to note to your broker which block of stock you're selling. And if it's not noted to the broker, if it's not noted on their Form 1099-B, then we assume that they use the FIFO method. And this means first in, first out. Meaning if you're selling a share of stock, the first share you bought is the first one to go. So in this case, if we're using the FIFO method, it would be the $300 share of stock, because that one was the first one we bought. And then the final thing you need to know is the sales price. And a stockbroker must reduce the gross proceeds from any commissions or transfer taxes related to the sale. So when you sell a stock, you get the sale price. So say we sold that $300 share of Apple for $600. Very cool. You made a profit of $300. But what also goes into the sales price is any proceeds or commissions or transfer taxes related to the sale. And this will lower your capital gains, because if you bought the stock for here and you sold the stock for this much money, but you also had to pay commissions or transfer taxes, then your capital gains goes down. And the way we note this is if the gross proceeds box is checked on their Form 1099-B, if the box for gross proceeds is checked, then you would ask the taxpayer for the amount of commissions or receipts or fees and add that to the adjustment for basis. So if you had $300, if you sold the $300 share of Apple stock for $600 and and had a $25 brokerage fee, then if the gross proceeds box was checked, then you'd have to subtract that $25 from your capital gains because it hasn't been paid. Because we're just noting the gross proceeds. But if the net proceeds box is checked with all the same information, then you wouldn't have to subtract it because it's saying that the $25 brokerage fee is already subtracted from the $300 capital gain. All right. So now, after we talked about the sale of stocks and mutual funds, how to calculate capital gains from that, now we're going into how to calculate capital gains on the sale of principal residence in order to report that on your tax return. So in order for a principal residence to even be called a principal residence, it must pass the main home and ownership and use tests. Through the VITA program, VITA volunteers can only handle the sale of a principal residence or main home. If a taxpayer has six vacation homes in Aspen, Colorado, we can't do that because it's way out of scope, because the VITA volunteer program is meant for help with simple returns because, like we said, we're volunteers, we're not held liable, meaning we're not doing crazy returns that could end up being wrong. We just don't want to put ourselves in that position. So only the sale of principal residence is in scope for VITA volunteers. Now, how do we know if it's a principal residence? We mentioned the main home and the ownership and use test that it has to pass. So for the main home test, only gain from the sale of a taxpayer's main home may be excluded from the taxpayer's income. Anything else is taxable and reported on the return. For the ownership and use test, the taxpayer must have owned the home for at least 2 years and have lived in the home as their main home for at least 2 years out of 5 years prior to the sale. There is an exception to this rule in that if you are a qualified official extended duty member, you don't have to live in the home, but it can't last for more than 10 years. So you have to live in the home for 2 years out of 10 instead of 2 years out of 5. And this is called the 5-test suspension. It's just basically an extension if your official duty, meaning the government-sanctioned duty such as military leave, doesn't allow you to live in the home for the past 5 years, for 2 years out of the 5. So once you've determined that, yes, your principal residence does qualify as a principal residence, and we're trying to calculate the capital gains you make from selling it, you're going to need to know the maximum exclusion, or the exclusion that the taxpayer could take. And an exclusion is basically saying that, hey, this portion of your capital gains you don't have to pay tax on if it's for a principal residence. And the maximum exclusion that a taxpayer can take is up to $500,000. And they can only take this if they have 1 or 2 filing statuses. And we talked about filing statuses in a prior lesson in Unit 1. I'll link that video, but make sure you go in there and watch it so you can gain a better understanding of what's happening with filing statuses. Why would you file for one status versus another? But the way you can take a maximum exclusion on the sale of a principal residence is if you're 1, married filing jointly, meaning you're filing a joint return with your spouse, and either spouse meets the ownership test and both spouses meet the use test, meaning they must have both lived in the house for 2 years out of 5 prior to the tax return. And the final thing that they must have is that neither excluded gain in the 2 years before the sale of a current home. So this basically means they didn't sell a home and take the exclusion before they tried to sell this one in the past 2 years. The second way you can gain the maximum exclusion is if you're a surviving spouse. And in this case, the sale of the principal residence must occur no later than 2 years after the date of the spouse's death. Upon death, some or all of the property may have a new basis based on the fair market value on the date of death. Because it's an inheritance property, it might have a new basis, meaning that you should check on their Form 1099 S that you're recording the right basis for the property if it's an inherited property via surviving spouse. Okay. For any other filing status other than surviving spouse and married filing jointly, the maximum allowable exclusion is $250,000. If the selling price is less than $250,000, it's not necessary to calculate gain because none of it will be taxable. So what we're trying to find out as VITA volunteers is how much of that capital gains is taxable. And because there's an exclusion, you'll take that capital gains minus the exclusion. So if the capital gains is 300,000, you'd minus 250,000, and it would be 50,000 of that capital gains is taxable, and you'd have to report that on the return. If the selling price is less than 250,000, obviously you're not going to have a capital gain higher than 250,000, so there is no need to calculate taxable capital gains because there won't be any. But what else do you need to know to calculate capital gains in the event that you will need to calculate it? Well, you first need to know the selling price, which is like the sale of stocks and mutual funds. It's the total amount the taxpayers receive for their main home. So this is what you sell the home at. You also need to know the basis, which we went over before. The basis for a principal residence is what it costs to buy or build that home. An inherited homes basis is generally fair market value on the date of the decedent's death. We went over that just in the last slide. If you're inheriting the home, it's generally the fair market value, but you just need to double check on that. The adjusted basis. So sometimes you're going to have taxpayers who are updating their home. For example, they're adding an extra bedroom, or they're adding an extra chimney. You don't need an extra chimney. You don't need a chimney to begin with. But if they wanted to add it, that would count as an addition to the home. And it would increase the basis, meaning the money you put into the asset. So adjusted basis, like we said before, it's basis plus increases minus decreases. And decreases are things such as casualty losses and postponed gains or depreciation, but they're out of scope for VITA volunteers. So if you have decreases on the adjusted basis for your principal residence sale, the VITA program cannot prepare that return. But increases would be any other additions or improvements to the home, and they must have a useful life for more than 1 year. So you can't just, if it's updating the relative standards of the home, so say your house isn't up to regulation and you're just fixing that doesn't count as an increase to basis because you're really just fixing the home to where it should have been in the first place. Increases would only be like if you're adding an additional room. Okay, and the last thing you need to know for the sale of a principal residence is selling expenses. And these reduce the gain by increasing the basis. So like we said with stocks and mutual funds, when you're selling a home at this price and you bought it for this price, but you have to include expenses or money that you're paying, your capital gains is getting smaller because you're increasing the basis or money that you're putting into the sale of a principal residence. These include commissions, advertising, legal transfer tax, things like that. Non-deductible losses for the sale of principal residence are out of scope for VITA volunteers, and the disposition of a home is reported on the tax return if any part of the gain is taxable. So we went over how to figure out capital gains based on if they had a cost sheet with documentation for Form 1099-B or 1099-S. But what if you inherit an asset or have a basis other than cost? Well, if the taxpayer acquired property by gift or inheritance, it should be listed on the statement, either 1099-S for real estate or 1099-B for brokerage for stocks and mutual funds. If they acquired this property by gift or inheritance, the taxpayer must provide the basis and acquisition date. Otherwise, it's out of date and out of scope. So if you're a VITA volunteer trying to prepare a tax return for inherited property, you can't do this unless they provide you the exact basis. Another basis other than cost that sometimes we come into contact with are wash sales. And this is the sale of securities at a loss and the acquisition of the same securities within 30 days of the sale date. So this is when sometimes people will sell their stocks and mutual funds at a loss and then really quickly buy up the same stocks and mutual funds within 30 days. And this will be noted on a brokerage statement or Form 1099-B, as we said. The disallowed loss from the first sale at a loss is then added to the cost of new stock or securities, resulting in an increase to basis of the new securities. So instead of just taking the loss and reporting it, So you're going to take this loss that you earned on the first sale and add it to what you paid on the second sale that you had, the second buy, when you had it within 30 days. And this postpones that loss until you sell the new acquired securities that you acquired again within the 30 days. And one other thing to note is capital gains distributions. This is often confused with just plain old capital gains. They're not the same thing. Capital gains distributions are a type of dividend, and they're reported on Form 1099 dividends. They're reported directly on the 1040, which is what VITA volunteers prepare an income tax return with a check mark indicating that Schedule D is not required. And Schedule D is basically just the additional worksheet saying, hey, this taxpayer had capital gains, and we're noting this. That needs to be taxed. All right. And with that, that is my lesson on capital gains and on the income section of the tax return. From this lesson, you should now know how to calculate taxable capital gains using basis, selling price, and the holding period to adequately prepare returns for your clients. Thanks for listening, guys, and have a great day. See you next time.